Welcome, ladies and gentlemen. My name is Nathaniel Organ, and I would like to welcome you during today's presentation about employee capital plans. I am a representative of the Polish Development Fund, or rather the subsidiary of the Polish Development Fund, which has been established especially to deal with matters concerning employee capital plans. Its name in Polish is Pfr Report PPK. And I am here today to talk to you and to give you a brief presentation for you employees of the main assumptions and general benefits that you can get from participating in employee capital plans. We will go through all the main points and the most important information regarding the program. So, what are the main assumptions of employee capital plans? Well, it's a new long-term saving program that has been designed for employees in Poland. Its main description would be that it's a private, common and voluntary system. Private because if you do not wish to participate in this program, you can resign from saving at any moment. Common because it includes all employees that work and earn on a contract that has mandatory retirement and disability pension contribution, and it's private. This is probably the most important thing. So all the savings gathered by you on your employee capital plans account are yours, are entirely yours, and they will wait on your employee capital plans account until you decide to withdraw them. This is also an important information that I would like to address to you. Employee capital plans are not part of the general pension system in Poland. So, for example, they do not comply with the same rules as the pension system in Poland does. A good example is the time when a Polish citizen by law is set to go for retirement. So in Poland, it depends whether you're a man or a woman. In employee capital plans, there is no differentiation depending on gender, and this is probably a good example in showing that this is not part of the pension system. It is a new and totally separate private system set to help you with long-term saving for retirement, but not only. Additional aims of the program include increasing meaning employees' financial security, generally improving the condition of the financial and capital market here in Poland, enhancing the economy's long-term development potential. Probably most important from these here, improving the structure of savings accumulated by household. So it is supposed to assist you in accumulating and gathering more funds, either for your latter stages of your life, or for other purposes on which I will mention later on in the presentation. So just to go through the program structure very briefly, the main point of the program are 3 sides that contribute to your employee capital plans. In Polish, the most common shortening is PPK, so Employee Capital Plans, or PPK account. Each parties that you can see on this structure, meaning your employer, the state, and you personally, contribute to employee capital plans account, and the funds gathered by you are then invested in target date funds by the chosen by your employer, the chosen financial institution chosen by your employer, but with consultation with you, the employee. What is important to say is that the Financial Supervision Authority here in Poland has control and supervision over all financial institutions that have been joined the program and are offering the program as a product. So you can so it's an extra sort of to give you extra security and confidence that that all the financial institutions are complying to the strict criteria. How does each of the 3 main parties included contribute? Well, let's start with you, meaning the employee. So from your total gross remuneration, monthly remuneration, you will contribute 2% of your salary as a basic contribution, and then additionally you can contribute another 2% if you wish to. Similar rules apply to the part of the contribution that is done by your employer, but as you can see, the percentages are a bit different. So the basic contribution from your employer is 1.5%, and the potential additional voluntary contribution is 2.5%, and then the third party that contributes to your employee capital plans account is the state, with a welcome contribution and with an annual surcharge. We'll go through more details regarding how these contributions work in the further part of this presentation. This is the schedule of employee capital plans, and it shows when the program is implemented by your employer, depending on how many people are employed in your place of work. The most important thing for you as an employee probably here is the last date for concluding the agreement for operating PPK. So this is an agreement that it's an agreement between your employer and the financial institution. In that regard, it's similar to the PPK's management agreement. But the difference in PPK between PPK's management agreement and the agreement for operating PPK is that the agreement for operating PPK is signed by your employer, but in the name of you employees. So that is one important thing. Another important information concerning the agreement for operating PPK is that attached to this agreement is a list of employees who would decide to participate in employee capital plans, and also this is the date from which contributions from your remuneration, monthly remuneration, towards your PPK account will be conducted and transferred. It's not this exact date, but it's from this date onwards, depending later on when your salaries are being paid by your employer, that you will start contributing to your employee capital plans account. The agreement, the PPK's management agreement is probably less interesting for you as an employee because it's more of a technical agreement between the financial institution that your employer in agreement with you employees chooses and the employer. So it does not concern you as employees as much as the agreement for operating PPK. Important information concerning really 3 age groups that decide to participate in the system. So very important factor is that the whole of employee capital plans is based on a system of auto enrollment. The system is it's been used with great success in countries like New Zealand and the UK, for example. And the way it works is that people in this age group that you can see here on this graph between 18 and 55, if they work at an employer who implements PPK and they from their salary have to pay a mandatory retirement and disability pension contribution, then they are automatically enrolled into the system. As I said at the beginning, the system is voluntary, so obviously employees can resign by submitting a written resignation to the employer, but you are enrolled automatically. If you are above 55 to 70 years old, then you may join the program, but it won't be done automatically. You have to then submit a declaration of accession to your employer, and then your details will be included in the agreement for operating PPK, which I mentioned a minute ago, and you will then join a program. So the main difference is that if you're in the age group above 55 to 70, you have to come out with the move to join the program. It won't be done automatically. People above 70 years old are unfortunately unable to join, but it doesn't mean that once you're in the program and you reach the age of 70, you are not able to continue saving. You can do that. It's just this is the information at what age and in what conditions you can join employee capital plans. Just from the practical side, a quick information about how you can access your savings once you start saving with employee capital plans. It isn't much different to a bank account in your own bank. So you can log in online to the financial institution that provides your employee capital plans account, and you can access your accounts, look at how many funds you have gathered, from what particular source, etc. So it is all to be accessed online by you, and the financial institution has an obligation to send you details concerning your employee capital plans account. Going back to the part about contributions about the employee, the basic contribution of the employee of you probably is 2%, with an additional voluntary contribution of 2%. But the basic contribution may be decreased under certain conditions. You can decrease it to a maximum of 0.5%. So you can choose to decrease it to, for example, 0.7 or to 1.1, but the maximum, the lowest figure is 0.5% under certain conditions. These conditions are that if you combine all your sort of total gross remuneration for a given month from all sources, this remuneration cannot exceed 120% of the yearly minimum wage, the given minimum wage in a certain year in Poland. And an important information here as well is that you can decrease it once you see that your salary does not exceed this point. You then decide to declare this to your employer, and you can lower the contribution. But if in a given month the employer sees that your contribution actually does exceed this amount, then he will not refer to your application to decrease your basic contribution, and he will sort of take 2% of your total gross salary for a given month to your employee capital plans account. So this is important to remember, as well as that this includes all sources of income, total gross remuneration. Now, once we have our funds and our savings on our employee capital plans account, what can we do with them? As I said at the beginning, the funds are yours. They are gathered by you, and you can also withdraw them at any time. You can withdraw them in exceptional situations, and you can transfer them to a different PPK account. So You can manage these funds the way you wish to, complying, of course, to the PPK Act. I said at the beginning that the system is designed to go on and keep saving till the end of till you reach 60 years old. The system does include situations in which you may withdraw the funds. Before that, though, first of all, you can withdraw funds in exceptional situations. And this is, for example, your serious illness of yours, of your co-spouse, of your child, and at that time you may withdraw up to 25% of your savings. You can also withdraw funds if you haven't reached the age of 45. If you wish to take a mortgage to purchase your own flat or to build your own house, and you can in this exceptional situation you may withdraw up to 100% of your the savings that you have gathered. The only important thing is that you have to return the amount that you decide to withdraw to your PPK account. You may also decide to return and to withdraw the funds that you have gathered on your account at any moment, and you've got all rights to do so. But the important thing here is that you will have to pay capital gains tax. You will have to return the surcharges from the state, so the welcoming contribution and the annual surcharge, and you will have to return 30% of the value of your employer payments. So we will illustrate this for you to make it easier for you to understand right now. So you can see your assets on your account, your own contribution, the profit that your contribution has made, and the part of the profit that might be taken because of the capital gains tax, and you can also see the employer's contribution and the state's contribution. And now, once you decide to withdraw the funds at any time, you can see that the whole of the state contribution has to be returned to the state. You also have to pay capital gains tax. It's important to remember here that capital gains tax concerns only the profit that your assets produce during the time they work on your PPK account. This tax does not refer to the whole of your assets, to the whole of your contribution, but just to your profit. And then 30% is of your employer's contribution goes to your social insurance institute account. This is the institution we call here in Poland it's called ZUS, and it's responsible for paying your, for example, paying your pension or your disability pensions, etc. You have to. This 30% goes onto your account in ZUS, but so it doesn't leave you. You as an employee regularly save funds on your ZUS account anyway, so this amount that is taken away from your employer's contribution to your ZUS account, this 30%, in the moment that you decide to withdraw, starts working for your ZUS pension, and it has an influence on the scale of your ZUS pension, so it will probably increase once your account receives these 30%. Those were scenarios presenting the withdrawal of funds before the age of 60. What are the options for withdrawing the funds after the age of 60? Well, these are much more efficient and much more convenient for you as an employee, because they do not come with extra charges as withdrawing funds at any given time, for example. So once you reach the age of 60, you may wish to withdraw the funds in 120 monthly installments, as recommended in the legislation in the PPK Act, and then they are paid out 120 monthly installments are 10 years, so they are paid out and during these 10 years. You may also decide to withdraw them in, for example, 140 monthly installments instead of 120. That is also fine, and you will not meet any surcharges then either. It's just that 120 monthly installments, so 10 years is the minimum. But let's say that you have reached 60, you are not working for 1 year, and you may need some funds at once. Does the PPK Act predict a situation like this? Well, it does. And in this situation, the second scenario is that once you reach the age of 60, you may withdraw 25% of your accumulated funds at once. So you have access to 25% of the whole of your savings accumulated on your employee capital plans account during the whole time, and then the remaining 75% will be paid out to you on very similar terms as in the first scenario, so in monthly installments over the course of 120 months. And these both scenarios are without any charges, anything like that. You get 100% of your funds. The PPK Act also comes out with a sort of proposition and a scenario in which you can which predicts situations that are probably not the most the happiest situations in our lives, and not the ones that we are waiting for, but they are very important, and the PPK Act states what happens with your funds in the moment, like a participant's death. which we do not wish, obviously, to anybody, but it's important to state what happens with the savings gathered on your employee capital plans in a situation like this. So, if you were married before, if an employee was married before passing away, half of the funds gathered by him or her will be transferred or returned or in cash to the person with whom he or she was married. It may be transferred also to his or she's employee capital plans account, or to EK or PPA, which are also systems of saving systems in Poland. You can see this on this graph. We've got your PPK savings, and half of them are paid out to your co-spouse, providing you were married. The rest are transferred to a person designated by the employee before his or her death. So this person has to be entitled. It can be the participant's wife. In that case, she will get 50% and 50%, so 100%. Maybe the participant's child, neighbor, etc. Anybody that is designated and entitled by this particular participant before their death. What happens in a different situation when we decide to divorce? Well, the PPK Act predicts this as well, and I will show you an example scenario in which they were a PPK participant has gathered fund on his PPK account, and we decide to divorce with our co-spouse, and we have common property. We do not have a common property division. And for example, I have funds on my account that I have gathered throughout many years, and let's say it's 10,000 zlotys, and my wife, whom I am in divorce right now, and I'm divorcing, has gathered 1,000 zlotys, right? So we exchange 50% of the savings that we both gather after the divorce. So if I had 10,000 zlotys, then 50% out of 10,000 is obviously 5,000 zlotys, and 5,000 zlotys goes to my former now wife's account. In case, if we look at in case of the wife, if we look into her perspective, she had 1,000 zlotys on her PPK account, and 50% of that is 500 zlotys, and that is transferred to my account. So it does not matter how much both sides manage to accumulate during the time of saving with employee capital plans. Is just a matter of the percentages. So it has to be 50%. And if the former spouse does not have a PPK account, then as a result of property division, the funds, the 50% of funds, will be provided in form of cash. Then it is with deductions or a transfer to a specially created fixed term account where these funds will stay. It's also important to say here, just referring a little bit back to the division of funds in case of participants' death. In all these circumstances that I went through, the funds do the transfers and the payouts during this time are not subject to any deductions in case of participants' death. So in all scenarios that we went through, we are talking about receiving 100% of the funds. And now we will look for a second through the perspective of the employer. As I said at the beginning, the employer contributes by paying a basic contribution to your employee capital plans of 1.5%, and your employer, if he's a good employer and he wants to motivate his employees or wants to present a benefit to them, he may decide to also add an additional voluntary contribution up to 2.5% to that. The important case here is that the employer has to clearly state on what sort of rules he is paying these additional voluntary contributions. If the amount of these percentage-wise differs depending on an employee. The only probably case that he does not have to do that if he decides to pay an equal same amount of the additional voluntary contribution to all of his employees' employee capital plans accounts. Your employer has also an obligation of information towards you as an employee, and this is a very important part, because this shows you that your employer has it's not voluntary for him to install employee capital plans. He has to do that. You as an employee have a choice to decide whether you want to participate or not. Your employer has to do that, and he has got obligations coming out of this fact. The obligation of information that your employer has comes in certain situations, and this duty to inform the employees comes, for example, when your employer is before signing the agreement for operating PPK, he has to inform all the employers between 55 that have finished 55 and 70 years old that they have the possibility of joining employee capital plans, and so that the employer has the possibility of concluding the agreement for operating PPK in their name. Your employer has also the obligation to inform you every 4 years that employees who resigned from saving in PPK, they will be put on the system once again. That the process of enrolling them will start again. This happens, just to give you an idea and a short description. We have sort of enrolling windows within our program. So every February, every 4 years, the window for those who decided to resign before opens again. First window like this will come in 2023, and then every 4 years onwards, so 2027, 2031, etc., etc. At this time, employees who resigned before will be enrolled into the system again, unless they come out with action and decide to resign again till the end of March in this process. They will have to make that decision. Your employer has got the duty to inform you that these windows are ahead of you and that you may be enrolled into the system again, because if you do not perform any action, you will be then automatically enrolled into saving. Your employer has also a duty to inform all your employee capital plans participants about the possibility that they have got the option to either decrease their basic contribution or take a chance and use or increase their voluntary contribution to the PPK account. There is also one more situation in which your employer has the duty to inform the employees, and this is in case of transfers. So this is a situation in which your employer decides that he wants to change his agreement, his managing agreement with the financial institution, and decides to sign a new one with a different financial institution. Through this process, your funds will be transferred from one PPK account to a new one with the new financial institution, and your employer has the obligation to inform you about this process. The third party included in the system is the state, with one-off welcoming contribution and an annual contribution. The welcoming contribution is paid into your account after 3 months of saving in PPK, which in practical terms means after three months, free payments into your PPK account, because they happen on a monthly basis. After this time, the welcome contribution will be transferred to your account in 30 days, once after the end of the quarter in which you have reached this number of 3 full months of saving in PPK. The annual contribution works on a little bit on a different condition. So we look at the total amount of savings and gathered by you throughout the year on your PPK account, and then the condition of obtaining is that the total amount of savings gathered by you has to amount to at least 3.5% of the minimum remuneration in Poland, the sort of something. Minimum wage is probably a more common and better name for it, which has to be 3.5% from 6 times the minimum wage. So if you calculate that, and it turns out that the savings gathered by you on your employee capital plans account are bigger and higher than 3.5% of 6 times the minimum wage, then you have all rights to obtain the annual contribution. Now, just a little bit about the financial institutions. To give you a brief idea, it's important to say that the financial institutions had to meet quite strict criteria concerning their experience on the market, their own equity, or the number of funds that they manage in order to join the program, and there are no financial institutions no financial institution that does not meet these criteria can join the program, and these criteria which you have on the right here are as I said, quite strict, but going along to more practical things for you as an employee, how does the financial institution manage and allocate your employee capital plans funds? These funds are allocated in something we call target date funds, which their strategy is to manage and to invest your savings in the best possible way and at your best interest. This interest and this strategy will differ depending on your age. So you can see the list of target date funds. Here we've got target date fund 2025, target date fund 2023, 2035, etc., etc. The name of the specific target date funds comes from the year in which the middle age group from this target date fund will reach the age of 60 years old. So if we've got a target date fund with participants born between the 1968 and 1972, the year in the middle will be obviously 1970. From then on, we look at the point in which people, or rather the year in which people born in 1970 will reach the age of 60. And that is obviously 2030. This is the way that the target date funds are named, which you can see here, and as I said, they are established for 5 years, 5-year intervals. What is the investment strategy? Well, you can see types of either shares or debts that target date funds will invest in. We've got these two parts that are most vital, the share part and the debt part, and the proportion in which funds will be allocated in both depend on your age. So let's assume you are, as a participant, 22, and you've got plenty years ahead till you reach 60. In a situation like this, your target date fund will automatically allocate most of your funds. Most of your funds is 60 to 80%, as you can see on the graph on the right, in the right top corner. And this 60-80% will be allocated in shares. Less 20 to 40% will be allocated in debt. This is to give you the chance throughout a long perspective, nearly 40 years of saving till you reach 60, to give a chance for your savings to grow, to work, and to create a profit throughout the investments made by the target date funds. But if you join at a sort of latter stage of your life, you join, for example, when you're 50 or 55, in situations like that, it will be the debt part that will be majority, in which your savings will be invested to guarantee you the security, and this will be the most important thing at this stage. But if you wish to, the PPK Act obviously allows you to change the investment policy of your target date fund at your will. So you have the right to do this twice a year without any cost in each financial institution, and you may decide, for example, then that you're 55, you may decide to change the investment policy of your target date fund and to change your target date fund into a much more risky one, or you might be young and decide to save much more conservatively. That is totally up to you. The PPK Act has given you an option to conclude this action in this area. This is more or less. These are more or less the financial instruments in which target date funds invest, both in the shares part as well as in the debt part. I will also add here that I will send you this presentation at the end of my presentation if some of you will be interested in looking at this in more detail. One more important information regarding financial institutions are operating costs. We from the Polish Development Fund would like to say that operating costs of a net asset value 0.5% per year are not only the lowest operating costs in Poland, but they are the lowest operating costs for these funds the whole world. this makes employee capital plans a very attractive program to save for your retirement or for other aims that you wish to save for. One more information is that a financial institution may also take a charge of a success fee of 0.1%, but they have to comply to some criteria in this regard, which mainly refer to a positive return in a given year. Shortly about the Financial Supervision Authority. So this is the official institution in Poland responsible for supervision over the financial and capital markets, and it is also the institution that will always be checking whether financial institutions offering employee capital plans meet the strict criterion which I mentioned just a second ago. Now, just a little bit about the institution or group of institutions that I represent today, the Polish Development Fund, and our role in implementing PPK, employee capital plans. I am representative of the Pfr portal PPK, so the subsidiary of the Polish Development Fund, which is responsible for gathering and providing information concerning the program, for educating during sessions as this one today, for example, and for running the official PPK website. We also have the PPK register, which is run by the Polish Development Fund. It's sort of the register of the whole system of participants and financial institutions. The Polish Development Fund also has a role in creating from the beginning the designated financial institution, which is one of the 20 institutions offering employee capital plans. And it's important especially for one reason. Designated financial institution in a PFR TFE cannot decline to establish an employee capital plan for an employer. Other financial institutions on the market offering employee capital plans may come to a conclusion and make a decision that they do not wish to establish this program for a certain employer. This designated financial institution cannot decline. So it is a sort of security buffer for all the employers. Pfr portal PPK runs the official source of information regarding the whole program. I would strongly recommend you using our calculators, both for the employer as well as the employee. Using these calculators may give you a chance to check how much you might save participating in our program, or for how long you have to save to reach a certain amount of savings. That there are also a lot of calculators for employers if you also wish to participate in other sessions, other trainings. You may find a list of them on our website and join them either online or live. We also have quite a lot of materials that you can download, also in English, especially for you as an employee. So general information about the program, and the only official information to be found there. This is all for today. I will finish my brief presentation of employee capital plans for all you employees. At this point, if you wish to receive or to find any additional information, I strongly recommend you to visit our website or take part in our training sessions. Thank you for today, and goodbye.